Auzubillahiminash-shaytanir-rajim. Bismillahir-rahmanir-rahim. Assalamu alaikum wa rahmatullahi wa barakatuhu. Welcome back to my channel, The Turquoise Gem. Well, student, in our previous video, I introduced the market structure, perfect competition, and we ended up with the marginalistic rule, that was equilibrium of the firm under perfect competition will take place at the point where marginal cost is equal to marginal revenue. But before that, you have to understand that what is revenue and cost, and what is total revenue and total cost curve. First, I will elaborate the definition of the total revenue and total cost, and then we will draw the figures and discuss the shapes of the related curves under perfect competition. First of all, what is revenue? Total revenue is the amount of the money a company or a firm brings in from selling its goods and services. It is the total income of a business and is calculated by multiplying the quantity of goods sold by the price of the goods. For example, if a company produces 100 widgets or gadgets, widgets mean gadgets or machines, and sells them for $50 each, the total revenue will be equal to 100 multiplied by 50 is equal to $5,000. In short form, we write total revenue as TR. So the total revenue would be 100 multiplied by $50 is equal to $5,000. Next comes what is cost. The cost or total cost refers to the overall cost of the production by producing a good or service, or overall cost of production by a firm, which includes both the fixed and variable components of the cost. So total cost is divided, or total expenses of the firm or a company are divided into the further two categories: fixed cost and variable cost. Fixed cost includes rent, lease costs, salaries, utility bills, insurance loan repayment, property tax, etc. Since you have to pay a fixed amount or fixed cost regardless of how much you sell, it does not depend upon the selling or how much you produce and sell. So you have to pay a fixed amount in the form of the fixed cost. It is not related to the amount or the goods or the production. It is not related to the production or how much you produce. Next is what is variable cost. It is called the cost of the goods sold, or it changes as the volume of production changes. It changes when the amount of the goods and the goods and the commodities change. So it depends upon the amount produced, unlike fixed cost, which has to be paid regardless of the volume of the production. In short form, it is written as VC. For example, examples are raw material, piece rate labor. Students, piece rate labor is the labor or the for example, if a worker or the if the worker produces goods and he is paid according to the each unit produced. For example, if a worker produces t-shirts or the bricks, then he is paid for the each unit produced irrespective of the time. Then it includes variable cost, includes commissions, delivery charges, delivery costs, packaging supplies, credit card fees, depreciation of the machinery. As machines, all of you know that the machines depreciate with the passage of time. So the expenses which have to be paid to run the machinery or to for the depreciation of the machinery, these expenses are also included in the variable cost. Now I have drawn total revenue curve under perfect competition. In the figure, in the upper part of the figure, I have drawn total revenue curve, and in the lower part of the figure, I have drawn average revenue AR and marginal revenue MR curve under perfect competition. On x-axis, I have taken output X, and on the y-axis, I have taken total revenue, the average revenue, and the marginal revenue. The total revenue curve under perfect competition is a straight line from origin, which shows that revenue under perfect competition increases at the constant rate. So it is positively sloped line from the origin. Now in the lower part of the figure, I have drawn average revenue and the marginal revenue curves. Average revenue curves and the shapes of the average revenue curve and the marginal revenue curves is shown in the lower part of the figure under perfect competition. And the average revenue and the marginal revenue curve under perfect competition are the straight line or the parallel straight lines that are parallel to the x-axis. because in the perfect competition the firm is price taker, it cannot influence the price, so it can sell any amount of the output at the fixed given price. Under perfect competition, average revenue is equal to marginal revenue is equal to price, and it is a straight line, and it is also the demand curve of the firm under perfect competition. Now I have drawn total cost curve and total fixed cost curve. In the upper part of the figure there is total cost curve. The total cost curve is inverse S-shaped curve, and it starts from the point A, and the OA is the fixed cost. It does not start from the origin, because total cost is the sum of fixed cost and the variable cost, and because of the fixed cost it does not start from the origin, it starts from the A, and the distance OA is fixed cost and the remaining will be variable cost. And on the x-axis we have measured output, and the on y-axis we have measured cost. And similarly in the lower part of the figure we have measured output on the x-axis and the cost on the y-axis, and the average fixed cost is, as it is fixed cost, so it is a straight line parallel to the x-axis. Now next term is AFC, or average fixed cost. In this figure we have drawn average fixed cost curve. Average total cost curve is drawn in the upper part of the figure, which is inverse S-shaped, and total fixed cost is parallel to the x-axis in the upper part of the figure. And in the lower part of the figure we have drawn average fixed cost curve. Now how have we drawn this average fixed cost curve in the lower part of the figure? It is basically the slope of the lines drawn from the origin 0 to the total fixed cost curve. So the average fixed cost curve is obtained by finding the slope of the lines drawn from the origin to the total fixed cost curve. So if we draw the vertical lines from the total fixed cost curve, then average fixed cost curve can be drawn by taking the locus of the lines drawn from the origin to the total fixed cost curve. So the average fixed cost curve is in the lower part of the figure, and which is rectangular hyperbola shape. This shape is called rectangular hyperbola shape. That is the shape which is asymptotic, and it does not touch the axis. So rectangular hyperbola shape is a shape that is asymptotic, or it does not touch the axis. Now next is variable cost curve. Variable cost curve is drawn, total variable cost curve is drawn in the upper part of the figure, which is also inverse S-shaped, just like total cost curve. As total cost curve is inverse S-shaped, but it does not start from the origin, but total variable cost curve starts from the origin, as it depends upon the level of output produced. When output increases, the total variable cost also increases, but total fixed cost remains fixed. In the lower part of the figure, we have drawn short run average variable cost, or SAV, and the short run marginal cost curves. Now how to derive short run average variable cost curve? Short run average variable cost curve is drawn by drawing the lines from the origin to the points on the total variable cost. Shorten average cost at any level of output is the slope of straight line from origin to the point on the total variable cost curve corresponding to the particular level of the output. It is shown with the help of blue dotted lines. Shortened average variable cost curve is U-shaped. Initially, when output increases, per unit cost of the production decreases. So, the cost curve shows is downward sloping. Cost curve, the slope of the shortened average variable cost curve is downward sloping below the point C dash. Then the cost reaches its minimum point at C dash, and then it starts rising because the per unit cost of the production increases. Average means per unit. Per unit cost of the production increases after point C dash. So the shortened average variable cost curve is U-shaped, which shows that initially when output increases, then cost increases at the decreasing rate, then it reaches its minimum, and then it starts rising with every unit produced. Now, shortened marginal cost curve is the locus of the points of the tangency on the total variable cost curve, as shown by the red color. The point A, B, C, D are on the points of tangency on the total variable cost curve, as the slope of these tangents show the slope of the total variable cost, and the slope of the total variable cost will be the shortened marginal cost curve. If we draw vertical lines from the points of the tangency and we take the locus of these points of tangency, we get shortened marginal cost curve. Shortened marginal cost curve is also U-shaped, and just like shortened average variable cost curve, it's first of all it decreases when output increases, then reaches its minimum point, and then it starts increasing with the unit production. Both curves are U-shaped. You should notice that, you should observe here that shortened marginal cost curve cuts the shortened average variable cost curve from its minimum point, and when shortened average variable cost curve or shortened average cost curve is downward sloping, shortened marginal cost curve is above the shortened average variable cost or shortened average cost curve, then at the minimum point both are equal, and after that minimum point, when shortened average cost curve is rising, shortened marginal cost curve is above the shortened average cost curve. Students, here is one important point to notice, that the slope of the lines of tangents, the slope of the tangent lines A, B, C at the point A, B, C, D show the slope of the total variable cost curve, as the lines are becoming flatter and flatter before the point C. It means that the cost is increasing at the decreasing rate because lines are becoming flatter, and after point C the lines become steeper. It means that the cost will increase at the increasing rate. Since point C is the point of inflection, or it is a point after which the curve changes its curvature, that is before convex to concave or before concave to convex. So the total cost curve was concave before point C, and after point C it changes to the convex. It becomes convex. So the point of inflection is a point at which the curve changes its curvature from concave to the convex or convex to the concave. Fi amanillah.